Hey everyone, and welcome. Have you ever looked at your pay stub, seen that deduction for benefits, and just kind of wondered what in the world you're actually paying for? If that's you, then you are in exactly the right place. Today, we're going to pull back the curtain on Canadian group insurance plans and show you how this workplace safety net really, truly works.
So here's our game plan. First, we'll talk about the big picture, why these plans even exist. Then we'll take a peek inside a typical benefits package. After that, we'll cover how to actually use it day to day. We'll also get into some of the smarter details, like taxes and special accounts, and we'll wrap up with a really critical piece of advice for whenever you leave your job.
Okay, let's dive right in. First up, your workplace safety net. We need to talk about why group insurance is so much more than just a nice little perk. It's actually an essential piece of your financial health here in Canada.
So this is super important to understand. In Canada, we kind of have a two-part healthcare system. You've got your provincial plan, that's the one we all pay for with our taxes. It covers the big stuff, right? Doctor's visits, hospital stays, major surgeries. But what about, everything else? That's exactly where your group plan steps in. It's specifically designed to fill in the gaps for things like prescription drugs, dental work, and vision care.
So how does this even work? Well, the easiest way to think about it is like a Costco run, but for insurance. Your employer is the one with the giant shopping cart. They go out and buy one massive policy that covers everybody in the company. And because they're buying in bulk, the insurance company can spread the risk across all those people. And that, right there, makes the cost for you, the individual, way, way lower than if you try to get that same coverage on your own.
Okay, so now we get why these plans exist. Let's get to the fun part. Section 2. What's actually in your plan? Let's crack open a typical benefits package and see what we've got.
The absolute heart of any plan is something called extended healthcare, or EHC for short. This is the stuff you're probably going to use the most. It helps cover your prescription drug costs, those really important paramedical services like physio, massage, or therapy. It also helps with vision care, think glasses and contacts, and even provides emergency medical coverage if you get sick or hurt while you're traveling outside of Canada. And of course, there's dental care. Now, your plan usually breaks this down into different levels. For basic stuff like cleanings and fillings, you'll probably see a high percentage of coverage, maybe 80 to 100%. But for major work, like crowns or root canals, it's often a lower percentage, maybe around 50%. And some of the better plans will even help out with orthodontics, like braces. But it's not all about cleanings and glasses. Your plan also has this incredibly vital financial safety net built right in. This includes things like life insurance and AD&D, which would pay out a lump sum in a worst-case scenario. But crucially, it includes disability insurance. If a serious illness or injury ever stops you from being able to work, this benefit is what replaces a part of your income. It is, no exaggeration, what can protect you and your family from financial disaster.
Now, this is key. Not all plans are created equal, not by a long shot. Just take a look here. A basic plan might give you a couple $1,000s a year for drugs and maybe a few hundred for paramedical services. But a standard or enhanced plan, the maximums are way higher. The real takeaway here is to find out what your limits are so you can plan your expenses for the year without any nasty surprises.
All right, so we know what's in the box, but how you actually use it. Let's get practical. Section 3 is all about the nuts and bolts, from how you pay for it to how you get your money back. So you might be wondering, who's footing the bill for all of this? Well, it's really a partnership. Your employer usually pays the biggest chunk of the monthly cost. We're talking 75, sometimes even 100%. Your share just gets deducted automatically from your paycheck. It's this cost sharing that makes such powerful coverage so affordable for everyone. And thank goodness the days of filling out paper forms and licking stamps are long gone. Submitting a claim now is ridiculously easy. You just open your Insur's app, pop in a few details about the service, snap a quick picture of the receipt, and hit submit. And if you've set up direct deposit, that money is usually back in your bank account in a day or two. It's really that simple. Okay, let's level up a bit and talk about some of the smarter details that can help you get the absolute most out of your plan. Section 4 is all about the important stuff: taxes, health spending accounts, and wellness spending accounts. Now, this is a part that trips a lot of people up, but it's super important. Taxes. When your employer pays for your health and dental plan, that's a non-taxable benefit. It's like tax-free money. However, the money they pay for your life, AD&D, and especially your disability insurance, that is considered a taxable benefit and it gets added to your income. That is a vital distinction you have to be aware of. Okay, some plans come with this amazing feature called a health spending account, or an HSA. And trust me, you want to know about this. It's basically a pot of money that your employer gives you each year to spend on any CRA-approved medical expense. Think of it like a flexible, tax-free fund for things like extra dental work or glasses that might go over your normal plan limits.
Then there's its cousin, the Wellness Spending Account, or WSA. It seems similar, but there's a huge difference. It's also a pot of money from your employer, but it's for a way broader range of stuff, like your gym membership, new running shoes, maybe a fitness class. But here's the trade-off for that flexibility. A WSA is a taxable benefit.
So, let's just boil it all down. Here's the absolute bottom line you need to remember. An HSA is for medical stuff, and it's tax-free. A WSA is for lifestyle and wellness, and it's taxable. Knowing that difference helps you use these accounts wisely and avoid any surprises come tax time.
All right, we've made it to our final section. And honestly, this might be the most important thing we talk about today. What happens to all this coverage when you leave your job? Because there is a critical and very short window of opportunity you need to know about.
The moment your job ends, poof, your group coverage is gone. But, and this is a big but, you have this special right. It's called a conversion privilege. This lets you change your group life insurance into your own personal policy. And here's the amazing part. You can do it without answering a single medical question or taking any exams. It is a guaranteed way to keep your coverage no matter what.
So what's the catch? It's time. And you have to remember this one number, 31.
That's right. You get exactly 31 days from the day your plan ends to apply. This is a hard, non-negotiable deadline. If you miss that window by even one day, the opportunity is gone, forever. There are no exceptions. This is so critical to remember anytime you change jobs.
So, there you have it. We've gone through the what, the how, and the why of group benefits. But now that you understand the basics, it really leads to a bigger, more personal question. Your workplace plan is an amazing foundation, for sure, but is it enough to fully protect you and your family?
Look, for most of us, that group plan is an absolutely fantastic starting point, but it's often not the whole story. If that question makes you stop and think about your own coverage, and you want to figure out how to build on that foundation, talking to an expert is a really smart next step. For some personalized advice, you can always reach out to Mansoor at Muneris Financial Services. All his details are right there on the screen. Thanks so much for watching.